Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. So what exactly is all of this recently positive economic news here in the U.S., along with the continued upward momentum of the stock market, telling us with regard to that old double dip recession talk that we once heard here? Our crack team of contributors will weigh in, namely Steve Reitmeister, our editor-at-large, our research director, Shiraz Mian, and that crack technician, Kevin Matris, all here at the roundtable.
A lot of crack.
Yeah. Good observation. I didn't want to continue too far down that road, but I'm going to start with Shiraz. Is that off the table now? No more double dip worries?
Absolutely. We all along here had been saying that the fear of double dip was overblown. We were seeing evidence in the economy that once this fiscal stimulus and monetary stimulus that the authorities had put in the system wears off, there will be enough strength and momentum in the underlying economy to take the lead from that. And we are now seeing evidence of that both in the retail side, in the housing side, as well as on the capital expenditure side. So yes, we here feel very good and happy about this fact that our call and our outlook for the fear of the double dip being unfounded coming true is the real thing now.
Kevin, he says we an awful lot. Is he speaking for you as well?
Yeah, he is. I mean, I think it was maybe a couple of months ago we were trying to put a letter on what shape the economic recovery was going to look like. And I think that it is an unequivocal V. If you take a look at the stock market, you saw this big dump, in March of last year. Mm-hmm. And you have seen the market do nothing but go straight up since then. So if you look at a long-term chart, it is a perfect V. And if you start looking at all of the economic numbers out there, if you start looking at a bar chart, right, which will plot the monthly changes, you can see that by and large those charts and those economic numbers are looking like a V as well. What's interesting is that over the last several months, really the last 9, 12 months, this has only just taken us back to the zero line. So we are right now getting to the point where you can see real growth in absolute terms. And I believe that the economic recovery has a lot more to go from here.
All right, so we can add you to the consensus?
No. I mean,
there's always a holdout in the crowd.
The idea of a double dip technically means that where the economy starts to come back and then immediately goes right back down. And I would agree that most likely that's not going to happen. It does look like we have real sustainable growth for a while. But I saw a guy on CNBC this morning who said it perfectly. He goes, I am a short-term optimist and a long-term pessimist, meaning that all that debt still exists. Okay? Right. All the paper that the government printed still exists, and somehow that has to be repaid. Right. How does it get repaid? You either need to increase the revenue base in the country by growth and things of that nature and keep taxing the same, or you raise the taxes and perhaps suppress the potential growth rate. I think we see that our government is probably moving towards the let's raise taxes down the road, and that does cap growth. And when that happens, it is more possible to have a recession down the road. So not a double dip as in right now, but over the next 3-5 years, I think we're going to be hard pressed to have this glorious rebound in the economy when there's going to be so much money to be repaid.
So Shiraz, this is now another headwind, along with the other headwinds of Greece, Wall Street reform, and Goldman, it would sound to me, that faces the stock market.
Well, the issues are there. We by removing this fear and this risk of a double dip recession from the economy doesn't mean that we are home free. And there are no issues out there on the horizon for the economy as well as the market. You mentioned Greece. Personally, in my view, the gangbuster growth in China and their need to rein in their own growth and remove some of the speculative excesses from their economy poses a greater challenge for the global economy and as a result for the U.S. economy. So yes, headwinds are there. But just a brief comment with respect to what Steve mentioned. what these long-term imbalances on the fiscal side for the U.S. economy does is that it brings down the long-term growth trajectory from, say, 3.54% rate to 3% and maybe a little less than that. Other than that, the long-term picture in terms of growth remains intact.
All right, quick.
Okay. But it also decreases the likelihood, or the rate of growth of corporate earnings,
sure,
which also, when we talk about what the average PE on the market is and what we should be paying, well, if the average growth is going to be slower, then we shouldn't be talking about what the average PE for the market is, which is where we're at. We should be talking about how we should be underneath that average because the earnings growth rate is lower, and that's kind of my point.
But check this out. What everybody is saying is that what's going to happen in 3 years or 5 years from now. What people want to know is, what am I going to do today? What am I going to do for next week? What am I going to do for the next couple of months?
True.
And right now, this economic engine is chugging along. And if you take a look at corporate profits, you take a look at the companies that are reporting earnings, they're doing great, and the market is responding. So we have to take kind of a closer view as well to figure out, yeah, sure, there's going to be some headwinds 3 and 5 years from now, but what about currently? Currently, the market looks strong.
So then what I'm hearing is, with stocks at a 19-month high, the fundamental economic developments that we're seeing right now are going to continue to overshadow these headwinds for the foreseeable future.
Yeah, and that goes to my short-term optimist, long-term pessimist. And I don't want to sound like I'm a total downer on the long-term prospects, but I'm a little concerned about what this means down the road, because that money does need to be paid back. And how they're going to get the money out of the citizenry of the United States, and what does that mean for cramping our style. But in the near term, absolutely, you take a look at the economic indicators, you take a look at corporate earnings, it absolutely says that things are healthy and on the rebound, and not surprising, the market has been pushing highs.
Kevin, quickly, I read an article this morning that indicates that the stock rally could be entering, according to the charts, could be entering an area of irrational exuberance. Does that mean anything to you?
It's quite possible. But if you are in while the market starts acting irrationally exuberant and it keeps on going higher, once the market corrects from there, no one's going to take your profits away if you pull those off the table. I think the market, I think I'm in the minority here, but I believe the market could be getting ready to enter into an acceleration phase to the upside.
Interesting. We'll have to pursue that at another time. We have to leave it right there. That's the latest thinking from this session of the Roundtable. And if you are accessing this video from outside of Zacks.com, you can always go to our homepage at Zacks.com for links to current commentary on a wide array of different issues regarding the market and the economy. With everyone here, I'm Terry Ruffalo.